Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Chris Marinac, Director of Research at Janney Montgomery Scott, to discuss the state of the U.S. banking system and how bank earnings performed this season. Chris, it's great to see you. Welcome to Trade Talks.
Thank you, Jill.
You got it. Are deposit and funding costs catching up with the surge in Fed fund rates?
Yes, absolutely. We've seen funding costs go up a lot this quarter. We particularly have been wide, about 3 points difference between the Fed funds rate and bank deposit costs. That is going to narrow further in the second and third quarter, and it definitely stepped up in the first.
Why are net interest margins a key measure for banks, and how are they being impacted by deposit and funding costs?
Sure. So the margin captures the spread between earning asset yields and funding costs. So as funding costs go up, it will narrow the spread. And we think that even though yields did improve in the first quarter, they're not improving as much as they would like. And I think there's going to be a squeeze that occurs. Again, we saw it in the first quarter. I think we'll see it again in the second. It really is a function of the flattening out of the yield curve, as well as the funding costs catching up after a very big lag in 2022.
We heard a lot about deposit outflows in March. Were they less than advertised, more, or really what we heard?
Sure. I think overall they have been down about 2% for the banks who have reported. The Fed was suggesting about 3 to 3.5. So definitely better than expected. I think there was a lot of misinformation in the month of March. And so now that we have some stabilization, we've seen that deposit outflows did occur, just not as much as advertised.
How are bank balance sheets performing in general?
Overall, I think the balance sheets have grown for the quarter, and more importantly, credit quality remains really good. We've only seen a modest uptick in charge-offs, and generally speaking, non-performing loans have been flat, and in many cases, actually slightly better than they were at year-end.
And finally, how have the banks revised their disclosures in the wake of Silicon Valley Bank and other bank failures?
Sure. We've seen several things new this quarter. First has been the uninsured deposits and deposit concentration details. That's been sorely missed during the crisis in March. So that's been very healthy to get that information out. Banks generally have less uninsured deposits than folks understood. I think we've seen better disclosures on real estate, particularly in the office segments. As folks get a better sense of with the office concentration, I think they worry less. Office is still a concern, but understanding how much banks have is very healthy. I think most banks are somewhere between 5 to 8% in office, which is a lot less than I think investors understood as March was unfolding.
All right. We appreciate the insight, Chris. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets